Good morning, everyone, and thank you for joining the Banking Tax Forum today. I'm Ian Woodruff, one of the partners in Grant Thornton's Financial Services Tax team, and I'm pleased to be your host this morning for the latest instalment in our series of tax events for the financial services sector. So just before we kick off, a couple of logistical and housekeeping points. So on the right-hand side of your screen, you'll be able to view your control panels, and this is where you can ask questions of our speakers. Just a point to note that the webinar is being recorded and will be distributed to those registered for the event once it's concluded. And the speakers are in various locations today, so apologies for any interruptions or disruptions that may be caused, but hopefully we won't experience any of those. Okay, so great. Let's make a start. So today's Banking Tax Forum comes at a really interesting time for the sector and for the UK economy more generally. So we're in a situation where we've got rising interest rates and interest rates at levels not seen for 15 years. We've got rampant inflation. Government debt has risen to more than 100% of GDP for the first time since 1961, other than the obvious brief spike during the COVID-19 pandemic. And all of this is likely to put much more pressure on the fiscal contribution of the UK banking sector, which contributed around 40 billion to the Treasury in the year to 31 March 22 and amounted to around 5% of the total tax receipts. So in the session this morning, we're going to look at three specific areas of tax and consider what banks should be doing to address these issues and take advantage of the opportunities that these present. So our first speaker this morning is John Garrett, and he's going to walk through the capital attribution tax adjustments, or CATA calculations, and discuss whether now is a good time for UK branches of foreign banks to be revisiting these adjustments. So looking at their current methodology with reference to HMRC's guidance and benchmarking against comparable rates and ratios. Following John will be Mo Mogra. He's going to be providing an update on the R&D tax regime and the challenges and opportunities presented by HMRC's new digital process for submitting R&D claims. He'll also consider the extensions to qualifying expenditure effective from 1 April 23 with respect to data and cloud computing costs and pure mathematics. And then finally, Martin Killer will provide an update on operational taxes. So he'll look at the proposed changes to the German withholding tax reclaim procedures, the new EU FAST proposal and its potential impact, the 2023 QI agreement and how that's going to work through for organisations, and then look at information reporting more generally and the increased audit activity that we're seeing from HMRC. So without further ado, I'd like to hand over to John. Thanks, John.
Thank you very much, Ian. As you say, I'm going to speak about the capital attribution tax adjustment that's reported to UK branches, and Ian gave a flavour of some of the recent changes that we've had. I'd also note that economically that low rates historically following the 2008 crash, but now we're in a period where we've got slowing growth. Inflation has been up to double digits in the UK and in many other major economies as well, and still remains rather sticky in the UK. And interest rates have gone from historically low rates, worldwide, certainly in the UK, but worldwide as well, but are now in a period of rising interest rates, and that all affects exactly what banks are doing. And when we're in the context of a branch as well, it could be that the branch is doing different sorts of business or taking on different risks than before. It could be that it's going in exactly the same direction as the head office branch, or that the types of things are done in a UK branch compared to the rest of the company may differ. And what this does mean is, and I will explain by reference to HMRC guidance, what we mean by the CATA, of course. It does mean that CATA adjustment, the calculation could change and potentially result in a higher disallowance for interest in tax computations of branches that we've seen in the recent past. If we can move on to the next slide, please. I'm underlying the CATA is the separate enterprise principle, which applies to all UK permanent establishments. And that says that what you need to do is to look at the profits or losses of the company as a whole and attribute some of those profits or losses to the UK branch or permanent establishment. However, the basis on that is a separate entity engaged in similar activities under similar conditions and dealing wholly independently of the non-resident company. However, supplementing that, apart from pages and pages of OECD guidance, we also have a bit of additional tax law and additional HMRC guidance. In particular, if we go on to the next slide, please, for bank branches, the tax law makes it clear that a permanent establishment is to be dealt on the basis of the same credit rating, and crucially, that the permanent establishment has the equity and loan capital that it would have if it was a separate entity carrying out those activities under those conditions. Very short in that nature of wording, but potentially a very complex computation that doesn't necessarily yield off one answer, but a range of answers for which a company needs to determine what their equity and loan capital is, so they can compete it with branch computation. And on the next slide, I've quoted the HMRC guidance as to why we need that CATA, and that essentially is to apply that separate enterprise principle, but in a banking context where we rely on capital, rely on money. Some of that's going to be equity, which you wouldn't expect to get any pay any interest on. Others would be loan capital and different types of capital indeed, on which there could be different interest rates. It may or may not be the case that the UK branch accounts already show a particular attribution of equity and loan capital to the UK branch. Even if they do, it may be the case that those management accounts don't reflect what would be the case applying the separate enterprise principle. And that's why we look at the CATA. We look at what we would expect to be normally the interest expense on the 0% on equity plus whatever the relevant rate is on the loan capital that be attributed to the UK branch. Compare that to what is in the actual branch accounts, and the difference is the capital attribution tax adjustment. And the initial way that the HMRC guidance sets out how to do this calculation is in 5 steps. If we move on to the next slide, I've summarised the first three steps there. And we can see with some of these that the changes to what's happened economically and how a bank has responded to these changes may or may not mean that some of these answers are going to be different. I will say if you're one of those branches that takes a different method than these 5 steps, I will note alternative calculations going on. But the first part of the HMRC guidance is to refer in a lot of detail to these 5 steps and to tie it into what you'd have if you're a separate entity, like a separate company in the UK, subject to the banking regulatory books of the PRA. And step 1 is to determine what assets are attributable to the permanent establishment, and that's by reference to the actual business of the permanent establishment has entered into. Has that changed over the last couple of years with the credit squeeze? Is it doing different sorts of, has it got different customers? Is it taking on different risks? Or is it really exactly the same as what you've done before? But certainly the assets that you attribute to the PE may be, and the methodology may be different from the past if something is done differently in the permanent establishment, either by design, the response to the economic circumstances, or because the immediate consequence to those. Having determined the assets attributable to the permanent establishment, the next stage is to risk weight those assets. Now, if you're just using PRA percentages, it may be that step 2 is going to be similar to what's before, particularly if step 1 you get the same sorts of assets as you did before, in the same sort of business. But if you've got an internal model, then step 2 again could give a different tax answer at that stage. Step 3 is to determine the equity capital if the PE was a separate enterprise. Equity capital isn't just your share capital, but would include any retained profits, as in retained in the branch itself for use in the branch. But if there have been losses in a year, which some banks will have had, then that may need to be topped up by an additional equity allocation to make good those losses. And if so, that could well give rise to an increased interest disallowance. If we move on to step 4, sorry, next slide, we've got step 4, having determined the equity capital, the next bit is to determine the loan capital. That's not just the amount of loan capital, but the type of loan capital, and you'd also need to consider what sort of interest would need to be paid on that loan capital. And of course, interest rates, as we said, have changed as well. So when we come to step 5, which is putting it all together, it could be that the loan capital that you've attributed or determined at step 4, you need to apply higher interest rates than what you have at step 5. And then finally, step 5 is to bring it all together to calculate actually what would the UK branch's interest expense have been had it had the right amount of equity capital and loan capital on the assumption it's a separate business. Compare that to what you've actually got in the branch already, and then that usually gives rise to a interest disallowance in the tax computation. So say we have seen companies do this and get, in the past, maybe have a rather negligible amount of CATA, but when they work it through for 2022, suddenly that shoots up by a few million pounds. Whilst that's on the 5 steps, if we go on to the next slide, the revenue does acknowledge that there can be alternatives to the 5 steps. Whilst the 5 steps are based on trying to apply the PRA regulatory rules, it does recognise that you're not going to be perfect in that. Certain practicalities and shortcuts may need to be made, but there are these alternatives which they set out. Clearly, if you use the first one, comparables are going to necessarily change over the last couple of years, and that will need revisiting. I know I also have a number of clients of my own which actually use that second methodology. They're based on funding for the company and the capital ratios of the bank to the PE. The guidance says whether you can use that provided the branch is doing something close to what sort of integrated into what the company is doing, isn't doing anything different, or if it is doing something different from the rest of the company, that you make an appropriate adjustment for that. Again, what's changed in that? What are the capital ratios of the banks is funding the company? Has it become more expensive over the last few year and a half as well? So the concept of doing the CATA, the legislation, the HMRC guidance behind that has remained exactly the same for what we have had in the past 18 months to 2 years. Is a very big change from what had been the normal. No interest rates, no inflation. This was often slower. Now we've got more inflation, we've got more interest rates. Different banks have adjusted what they're doing for the new economic conditions in different ways. And what that does mean to my mind, is the methodology still fit for purpose? Does it recognise what the branch itself has been doing, is doing, or does anything need to be changed? The banks will have to give answers to that. But I think if you don't have any consideration at all to that, then if they put themselves down the line of revenue receiving, they're not reassessing some form of reassessment. Doing the extent of that reassessment will depend on the particular circumstances of the UK branch. But it is something that needs to be considered given the big changes in the economy and possibly the changes to how bankers adjust these two matters. Now I'll pass over to Mary to speak about R&D.
Perfect. Thank you very much, John. Appreciate that. Good morning, everyone. So as a quick intro, I'm a director within the innovation tax team here at GT. Really pleased to be here today, and I look forward to sharing with you some of the main changes in the R&D space. The biggest that we've definitely seen since the setup of the regime around 20 years ago, which has brought about along some great news, but also caught out a lot of claimants by surprise, which I'll now dive into. So if you don't mind going on to the next slide, please. So going back to the spring statement last year, the government set out its plans to get the UK in a prime position for investment. And by that, it wants to attract the best innovators, talent, and companies. So the government set out their aims to increase the overall GDP spend from 1.74% to 2.7% over the next 5 years. And by the end of the decade, it wants to be recognized as a science and technology superpower. So essentially, there's 4 key areas of focus which HMRC have carved out, as we can see on the screen. To start with the good, we're seeing headline rate increases for RDEC claimants and the introduction of cloud computing and mathematics as qualifying costs and activities. However, the introduction of new qualifying items is expected that HMRC would want something in return, especially in light of all the recent news we're seeing around some of the fraudulent activity taking place. So with these changes, they look to be tying up the scheme by increasing the substantiation element and documentation. And they're also looking to eventually carve out overseas R&D as they look to shift the focus from overseas R&D activity back into the UK. So let's dive into a little bit deeper into each of these. So if you don't mind going into the next slide, please. So the first being the headline rate changes. As we know, great news for RDEC claimants. So the RDEC rate is increasing from 13% to 20%. So that represents a 50% net increase, which is the biggest we've ever seen since the RDEC was actually introduced back in 2013. So great for RDEC claimants, definitely going to see a massive improvement in the overall bottom line. However, on the flip side, SME claims or SME super deduction rate has drastically dropped, such that loss-making companies will now only receive half of what they previously had. So previously, before it was 33p to the pound for every pound that was invested in R&D, it's now dropped down to 18.6p to the pound. However, there is a small clause whereby R&D intensive SMEs can claim 27% based on research that we've done. We think it's actually going to be quite difficult for those companies to qualify as high intensive R&D SME companies, mainly because if you're in a group situation and if you've got a number of companies in place, there's an R&D fraction that you have to apply, and essentially that will just bring down your R&D ratio. So essentially, it's unlikely many companies would actually benefit from the high intensity R&D ratio. So if we go into the next slide, please. So extension to qualifying expenditure and activities. So this is an interesting announcement from HMRC. That they've now decided to include all data and cloud storage costs as a qualifying cost category, but previously before it was only specific cloud computing costs that could be claimed. Clearly there's some winners here, especially where certain businesses have huge cloud storage costs, for example, in the technology, media and telecoms businesses, but other industries may not be so well rewarded. Definitely we think financial services businesses, as they're going through sort of finance transformations and moving things onto the cloud, they're definitely going to be, big benefactors of this new sort of qualifying cost category. I'd say the key actions to take away from this is HMRC will expect a reasonable apportionment approach. So you may want to start modeling ways to start tracking which costs are in relation to R&D effort versus business as usual type activities. They've not provided specific apportionment methodology as of yet, but there are a few options available. For example, individual user basis or space basis. Also, license payments for datasets would only qualify if the datasets cannot be resold or have a lasting benefit to the business. So you need to be cognizant of the intention before the actual usage of the asset itself. So worth bearing this all in mind when you're looking ahead. You'll also see the section at the bottom which discusses about pure mathematics. So yes, the government have introduced pure mathematics as a qualifying activity. Pure maths is the branch of mathematics most concerned with mathematical concepts such as trigonometry, number theory, algebra, all the good stuff that we learned back in the days when we were doing our GCSEs. But what does this actually mean? So this will expand the areas of qualifying activities as well as costs, which will ultimately increase your R&D claims further, but there's an element of pure maths involved in the R&D process. Our view is based on the research that we've carried out looking at comparable regimes such as Canada, which is quite a lot more advanced than the UK. We think mathematical analysis will be included as a supporting activity. Excuse me. They may even look to go even further and allow advances in pure math in itself as a qualifying activity in its own right. We're still waiting for formal guidance from HMRC, so there's still a little bit of uncertainty in terms of how exactly this will be implemented until the final legislation is printed. So again, what does this mean? Again, this is going to bring about new opportunities to optimize claims further. Roles which were considered to be non-qualifying R&D, such as actuaries, data scientists, and the like, who are involved in some form of math element, may now be potentially included. We think based on this, financial services businesses, particularly fintech businesses, are going to be the biggest winners from this. So if we go on to the next slide, please. So overseas R&D. So this is quite an interesting part because there was a lot of news about overseas R&D being carved out and restricted. That's still in place, but what HMRC have announced is now being pushed back to 1st of April 2024 instead of it being 1st of April 2023. So essentially, if you're a December year-end company, the first accounting period that you see this having an impact is from 1st of January 2025. So what we're doing currently, we're advising clients model the impact now, because this is going to be coming in at some stage at some point. And so it's best to obviously start modeling the impact now so you can understand what impact it's going to have on your bottom line, on your R&D claim. So we're working with businesses currently just to see how that impacts them as well. We're also having conversations at board level as well in terms of where companies should place the R&D teams, whether actually it's more commercially lucrative to keep them overseas or actually perhaps bring them back into the UK. There is a slight positive news in that there are some special circumstances, whether it be legal or regulatory reasons, which prohibit a company to do R&D in the UK, and it has to be done overseas. But again, just looking at the wording of the legislation and based on research that we've done, it does seem to be quite difficult for companies to apply for those exemptions. So I would say probably don't bank on that. Probably start thinking about planning ahead in terms of potentially if it's worthwhile exploring R&D credits locally in the jurisdiction where you've got your overseas R&D teams there. So we go to the next slide, please. So on the final point, on the substantiation element, so this is creating quite a bit of stir and commotion in the market. So those who are submitting R&D claims are probably familiar and aware. Typically, what gets sent to HMRC is a report which describes the background of the company, discusses the methodology as to how the claim has been quantified and qualified. It also gives HMRC some example project descriptions which detail how those projects have met the R&D definition for tax purposes. Typically, those reports would probably be around 15 to 20 pages in length. And obviously they would vary across the board depending on who's actually prepared or supported in terms of preparing that report. But now HMRC are looking for more granular level information, such that they are now seeking project descriptions up to 10. So previously, before, it only used to be 2 or 3 that used to get submitted, and that's 10 per claimant entity. So if you're in a group situation and you've got multiple entities within your group claiming R&D credits, you potentially could be looking at more than 10 project narratives to be submitted to HMRC. This form is a digital process, so it sits outside of your CT600 return. And there's a lot more information that's being asked from HMRC, a lot more granular information. So HMRC are now expecting to see qualifying cost by project, where previously before that wasn't asked. Also, they're looking to see of the qualifying cost by project, how much of that relates to direct qualifying time versus indirect qualifying time. And there's some also other prescriptive elements. For example, if you include externally provided workers, naming some of the providers on there. I think the form has been released and more than happy to obviously circulate what that looks like following the call. So if you're interested, do drop myself or Ian Woodruff a message and we can circulate that. But essentially, what does this mean? This means that companies are now going to be required to get better when it comes to their data reporting, capturing the time and costs, not only just to optimize the claim, but to substantiate the claims. We think the form itself is going to expand over time, naturally, as HMRC better refine the process and what it looks like, and once it takes into account the feedback that is received from claimants in the market. So definitely recommend companies to get ahead of the curve on this and try as best as they can to try and capture as much good information as they can. not just from a cost perspective, but also when it comes to the activities that have been undertaken, working with your technical leads to capture that good technical rationale that supports the R&D element. So we go to the next slide, please. The pre-notification of claims, I don't think this will be relevant to most of the attendees on the call, but essentially it's a new requirement, and we mainly think it's to help HMRC sort of manage the flow of claims that are coming in. But essentially, if you've made an R&D claim in the past 3 years, a pre-notification is not actually required. If you're, for example, a new business or fintech business that just set up, essentially you've got 6 months from the end of your accounting period to notify HMRC that you are intending on making a claim. What we're advising companies is whether or not you fully understand your operations or not, or whether or not there's a potential R&D claim to be made, still notify, particularly if you're a new business, because you don't want to be missing out on any R&D benefits. If you go to the next slide, please. So some potential upcoming changes in 2024. I'm sure most of us are aware there was a recent consultation that kicked off earlier in the year. So HMRC are looking at potentially combining the two schemes together. So basically everything I've talked about could potentially be scrapped in a year's time. But it's looking like the schemes will be combined together, mainly to sort of simplify the process and convert it more to a sort of RDEC overall scheme. Whether or not there's going to be differing rates for SMEs and RDEC are still to be known. And hopefully we'll find out some more information from HMRC late in the summer. That consultation period has now closed, so hopefully by the end of summer we should get some feedback from HMRC in terms of what does that look like. It's interesting because the UK does operate two different regimes, when actually when you look at some of the more advanced countries such as Canada, I believe, I think they only operate under one regime. So actually moving to one sort of regime does make sense. It makes the process a lot more simple. But we also want to make sure that SMEs and high intensive businesses are not missing out on any potential benefits. I think we're on the last slide. Go to the next one. Yeah. So you're just planning ahead. So I recommend obviously reviewing your data, identifying what costs are eligible, improve any sort of tracking where possible, working closely with your technical leads, because obviously you want to try and optimize your claims as much as possible. As I mentioned, obviously with the additional information form now being mandatory from 1st of August, it's imperative that businesses are capturing that detail as accurately as possible. Obviously, R&D, yes, that's been pushed back by a further year, but we'll still, advise companies to start modeling the impact now. So when the changes do come effective, it doesn't catch you out by surprise. And then obviously thinking about the documentation that you have, thinking about how best to sort of capture your information, and also thinking about real-time reporting. So we're having more and more conversations now with businesses to help them capture R&D on a more real-time basis, just to make it easier rather than looking at claims retrospectively. We do have a tool in-house that helps support businesses capturing that. So if at any point you'd like for us to do a demonstration on that, we'd be more than happy to arrange that at a suitable time. And I think that brings me to a close. Perfect.
Thanks, Mike. Thank you. Thank you. Good morning, everybody. I'm Martin Killer. I'm a partner in our financial services tax team. I lead on operational taxes, and I just want to spend a few minutes today just going through a few of the sort of current updates around changes in various markets which are impactful for banks, particularly trading or operating cross-border. So a number of these issues will apply both in the UK and some will apply further afield. So we go to the next slide, please. So what I'm going to cover very briefly are the changes, actually now the actual changes to the German withholding tax reclaim procedure. And then we'll talk about the EU proposals for creating a potentially faster reclaim process. We'll then move on to the US Qualified Intermediary Agreement and summarise the changes there that have happened since the start of the year, but we're still seeing many clients and within that number of banks trying to address some of the compliance changes which have been introduced by the IRS. And then finally, we're going to do a quick canter around a number of jurisdictions, but particularly around the EU. There's been quite a lot of development over the last year or so around new directives in the information reporting space. One or two things coming down the line very imminently, which again, banks in particular need to be ready to address the extent to which they've got operations or impacts of customers in the EU. So just move on to the next slide. Okay. So we'll start off talking about the German withholding tax reclaim procedures and the new process, which actually kicked off from 1st January this year. But it's probably fair to say, like with a number of these areas, whilst the rules or the processes change at a certain date, it does take some time, often for market participants to react to those changes or have a need to react to those changes because of the way in which some of these processes are looking back over a period. So I think the real key thing here is, whilst on the face of it, the German tax authority is moving to a purely online electronic form of reclaim process in itself be commended in terms of efficiency and in terms of improving the accuracy and hopefully the response time for reclaims. We are seeing a number of issues with our clients and with other participants who have had issues either getting access to the new system or, for that matter, once they have registered, trying to get their money back from the German tax authorities now within the new process. So it's worth just highlighting a few points on this slide. As I say, it's a purely web-based online form. So for anyone that's dealt with reclaims in other European or, for example, even the IRS, you now have a process by which you need to register in advance to get access to this new portal, both at the federal tax office level and at local tax office level as well. So people will know in Germany, typically when reclaims have been made, certainly historically under the old paper-based rules, you needed to actually file claims both at the federal level and at the local level, which is in relation to where the distributing companies' tax affairs were based. If you just hold on a moment, I'm just going to put my headset on because I've had a comment that people can't hear me very clearly. So if you just bear with me a moment. Okay, we'll kick off again. So just in terms of that German reclaim process, as I said, a number of clients and institutions have had issues getting access to the system, and that's an area we can support clients with, to the extent to which they're having problems. In terms of as I say, the registration is required both at federal and potentially at local tax level, similar to the previous processes. But it also covers areas where you may be using, or a bank may be acting as some kind of custodian or administrator and supporting other clients, their clients, in terms of making reclaims. So again, there are additional processes that need to be adhered to with respect to those kinds of roles taken by banks acting on behalf of claimants of German withholding tax. And even once you have registered on the system and got access to the relevant sections of the portal, there are then obviously a whole series of other documents that will need to be uploaded, typically in order to support a reclaim. For example, tax residency certificates, tax vouchers, the ones written in German, the ones that evidence the withholding tax that's been deducted, and potentially other disclosures are required depending on the complexity of the type of reclaim that's being processed. But it's fair to say there are a number of issues that the participants have faced, and happy to support institutions to the extent to which they have difficulty there. If we just move to the next slide. So I suppose in slightly more positive news, most of the material now on the German tax authority website is available in English, unlike the previous manual processes. So there is now a lot more support, a number of fact sheets and checklists that the German tax authorities have also introduced. So there is support and guidance there. And as of April this year, the forms themselves have been made available in English. So in many ways, there is definitely helpful guidance has been added. Probably worth saying, in the context of ongoing sort of German tax inquiries into historic reclaims, there is still there can be in some cases reasonable significant delays in terms of settling tax reclaims by non-residents, and some of that goes back to the historical experience of dealing with certain transactions that the German authorities are still investigating around the CumEx type transactions. But even in the most sort of plain vanilla of reclaim cases, some reclaims are taking some time. Can we move on to the next slide, please? So in terms of then moving from Germany into the wider EU gamut, in terms of the proposals that were issued a couple of weeks ago by the EU Commission, people may be aware that there were a number of consultations issued at the EU level over the last year or so, which have looked to try and simplify and consolidate a number of the different withholding tax processes that exist across different European markets. So the proposals that have been or now been endorsed by the European Commission and are now subject to final sign-off in the European Parliament, hopefully imminently, are trying to get some kind of standardised processes in place. But as with anything that needs agreement across the European member states, what they're proposing are 3 or 4 very clear or initial steps to try and get some conformity across markets. So proposals are focused on introducing a common EU digital tax residence certificate that will be available to be used by all beneficial owners across European markets. That obviously needs to be format, obviously will need to be agreed by European member states effectively through their own local laws, but that will be the main driver from which a potentially faster, as they're calling it, reclaim process will then follow. So once electronic residence certificates are in place, the next step will be for European markets to agree a process where they currently don't offer a relief at source process. So therefore, customers or investors are having to make reclaims into that market. The intention is to try and introduce a faster refund process whereby tax may be repaid within a period of 50 days, as opposed to the current experience of having to wait potentially more than several months and maybe even years to get tax back. So this faster reclaim process will work ineffectively by way of the beneficial owner providing the electronic certificate to the bank or the institution to whom from which they're receiving European source income, whether it's dividends or interest. And ultimately that bank based in the European Union will then be validating information back to the source country from where the original dividend was paid. And they'll do that by way of this third block here, which is the standardised reporting obligation, which will be the means by which the bank, or the intermediary as we call it, will pass back certain information, having done due diligence on the residency certificate and other information they collect from the end investor, and validating their tax residency in order to give credence to the source state to enable a reclaim to be processed in this much shorter time frame. So a number of different steps in the process, and clearly the intermediaries who will be tasked with the due diligence and validating the information on the end investor will have a certain risk attributed to them to ensure that those forms are validated and approved in accordance with the relevant rules, but equally to then allow a reclaim to be processed on a timely basis. So there will be further clarification around how these rules work. The directive will then have to be introduced or implemented across all the different EU member states. EU member states will need to sign up, obviously, to introducing electronic certificate on a conform basis across different markets. And ultimately, financial intermediaries based in the EU that process these kinds of reclaims will need to be signing up to validating and following these particular processes and providing information back to the source state. So a number of steps still required to obviously to be implemented. The EU envisages a start date of these rules of 1 January 2027, which obviously is some way away, but given the amount of agreement still required at an EU level, and then getting controls and processes in place for each of those banks and intermediaries able to process these reclaims on this envisaged time frame, it's still quite a challenging time frame when you bear into mind all the things that need to change in order to bring the process to life. Let's move on to the next slide, please. So that was everything European. If we now shift to the US market and corporate intermediaries, I'm aware that obviously this is a regime that's been around for over 20 years now. Some banks are corporate intermediaries, principally where banks are acting as custodians or brokers or other activities where they are collecting income on behalf of their customers, and that they have exposure to the US market is where historically banks have typically entered into QI agreements. So we have, as of 1 January 23, a new QI agreement, which, as ever, was built on previous agreements and introduced additional requirements. So just as way of snapshot, we've now, for those QIs that will be certifying under the new agreement over the course of the next 3 to 4 years, there are additional requirements in terms of the actual certification process, whereby banks operating as QIs will need to demonstrate they've undertaken annual reconciliations of the reporting that they're required to submit to the IRS. They'll be required to upload a copy of any peer review report. So that's an external or independent-based review of their compliance activities with respect to QI. That will now need to be provided to the IRS upon certification. In addition, where individual reports are issued to customers to enable them to make reclaims directly to the US, there's now split timeframes have been legislated to ensure that, that forms are issued on a timely basis. And so the big change on the bottom left is around what we call 1446F, which are really rules, US tax-based rules around the treatment of US public traded partnerships, where if those securities are now brought within the QI agreement, there are much more significant compliance obligations that QIs have to undertake in order to be more compliant with the QI rules, but to ensure there's effective taxation and reporting of those customers that hold the partnership securities. So there's some of the really big changes which have been announced as part of the new QI agreement. If we move on to the next slide. So in terms of other, I suppose, more practical considerations when it comes to the making certification and dealing with QI compliance generally, coming up from that point around the publicly traded partnerships change, there are now various options for how QIs will need to deal with their obligations where they have PTPs in their security portfolio. And it's definitely worth, if you haven't thought about it already, you know you've got exposure to those kinds of securities, thinking of definitely implementing some kind of change to deal with that, or putting blocks in place to prevent trading of those kinds of securities. And we've certainly seen all activity since the start of the year with many clients, many banks and QIs looking to remove their exposure to those kinds of securities. With any enhancements in the certification process, there is a need for increased governance, particularly around the responsible officer and around the checks that are in place that the RO has to ensure there is effective compliance through the organisation and that the compliance programme is being adhered to. Communications with clients are clearly always an issue where there are changes to compliance obligations of the QI itself. You may need to be reaching out to clients on a more regular basis to get new documentation, but also in order to ensure that they are aware of the underlying changes that have been implemented in the US. Clearly, the costs of compliance potentially increase as a result of the increase in more onerous obligations. And certainly in that space of public traded partnerships, the documentation requirements of QIs are now substantially increased. If you move to the next slide, please. So in the wider context of information reporting, I just wanted to touch on a couple of issues which have come up, which are clearly impactful for banks operating in the EU. So if we just move to the next slide. So CSOP, Central Electronic System of Payment Information. This is a new EU directive that takes effect as of 1 January 2024, which is basically a VAT avoidance directive, which was implemented in the EU to clamp down on, payment in order to identify cases where VAT avoidance was taking place. But as with anything, it's actually got a very broad nature and has significant impacts for any kind of payment institution in the EU, which will capture all banks and other types of electronic money and other payment service providers that are caught under the Payment Service Directive 2. So as I said, effectively what it is a significant amount of data reporting required on a quarterly basis starting in 2024. In fact, the first reports are due to be submitted at the end of Q1 next year, and they'll be submitted into a central European database in order for European tax authorities to then identify where payments are being made. The definition of payment is very broad. That's any cross-border payment that goes from one EU country to another, but also from one EU country to outside the EU. And where a payment service provider makes more than 25 cross-border payments per quarter to a beneficiary, either another EU country or non-EU, they are required to disclose the variety of payments they make to those beneficiaries on a quarterly basis. As with other European legislation, the space of implementation across the EU has varied. I think at the last check, we've got about 10 out of 27 member states, about 10 countries have fully implemented legislation and provided some form of guidance to institutions to enable them to comply, but there are still gaps across other European member states. And the penalty regime for any issues around reporting are also varied. We've seen different types of penalty regimes being introduced across different countries. And there's also interaction with GDPR. Whilst under some reporting regimes, reporting more than is required is not necessarily a sort of bad thing or a fail-safe route. In these instances, there are clear issues around crossing the line into GDPR issues if you report too much information. So from an impactful point of view, most banks with operations in the EU are really focused on looking at data requirements and trying to understand where the various data systems have data sitting in order to be compliant with these rules. Should move to the next slide, please. So very quickly, I'm conscious we're at 11:15 to allow time for questions. So the other changes on the information reporting front, just worthy of calling out on the Common Reporting Standard, we are following the OECD announcements and recent approval of the changes to CRS expected to start from 1 January 2026. There are a whole batch of changes, both in terms of the type of reporting to be submitted by reportable financial institutions across all jurisdictions. So this is really the granular information around the types of accounts that are being reported on, whether they're new or pre-existing, whether customers have provided self-certifications to financial institutions, and a whole other range of reporting changes which will be implemented on that time frame. And in addition, there are, under these proposals, specified electronic money products and other central bank digital currencies will also become part of the reportable financial assets, which are subject to CRS reporting. So again, we'll keep you updated on those changes. But at the moment, some people are starting to undertake impact assessments of these rules to understand the full impact where they're already doing CRS reporting. And these rules will impact both in the UK and more broadly as a result of the OECD proposals and equivalent rules being introduced under DAC 8 in the EU. Just move to the next slide. And then equally, as well as the CRS changes, we've also got a new regime called the Crypto Asset Reporting Framework, which is being introduced on the same time frame by the OECD. This is really looking at those banks and financial institutions that either provide either trading crypto assets or provide the means by which their clients can get exposure to crypto assets. So historically, those kinds of products have not been subject to CRS reporting, but under these provisions, the crypto asset rules will become part of effective extended CRS reporting regime, and there are rules by which, if there is conflict between the two regimes, as to whether you report under CARF or CRS. But broadly speaking, for banks which offer crypto products, they'll be required to obtain tax information on those customers that hold those crypto assets going forward, and be required to collect self-certifications like they would do for other traditional types of banking products that they have done for a number of years under CRS. Should we move to the next slide, please? So just in terms of timelines, really, as I said, the question of when these CRS changes and CARF, the crypto asset reporting framework, come into force, it's likely to be, I suspect, the earliest, probably 1 January 26. But in terms of the preparation for that, we now have rules, at least from the OECD perspective, from a UK standpoint. We expect HMRC will consult on the rules, and that will be followed by draft UK regulations and guidance. A number of banks are now starting impact assessments to understand the impact of these rules for their businesses around new products they already offer, but also looking at those particularly granular reporting changes to see whether they've got information captured already in existing systems, or whether they will need to actually introduce new procedures or new processes to capture those new data requirements. And then there'll be a period of systems change, obviously an allowance for implementation before the rules go live. As I said, probably the earliest 1 January 2026. Just next slide, please. And as I said, that's DAC 8. DAC 8 is the European equivalent of the crypto asset reporting framework, and that will, as I say, that has been legislated by the EU Commission, and that will be implemented across all the EU member states. The earliest start date for DAC 8 will be 1 January 2026. So you can see it would make logical sense, at least for the OECD rules, to commence on the same time frame. But that is to be confirmed. I think that, moving on to the next slide, I think we're now on to questions. Thank you.
That's great. Thanks, Martin, and thanks to the other speakers. If anyone has got any questions, if they want to drop them into the chat, then please do so, and we'll pass them on to the speakers. Just I guess a comment from me, John, on the kata calculations. The 5-step framework that you set out, is useful and provides that framework for performing the calculations. But there is a fair degree of sort of optionality around the rates and ratios used in that, and I think at the various steps, and I think that does provide UK branches of foreign banks with an opportunity to revisit their calculation. I guess as an example, at step 5, just something that we've seen recently within our client base is the market funding rate, which is used to cost the shortfall the shortfall or excess in equity and loan capital that's been identified in the previous steps. That market funding rate, that there is some scope around what rate is used for that. So in our particular instance, the client that we were working with was using SONIA plus a spread for the rate that they applied to that shortfall. But HMRC's guidance doesn't mandate a specific method. So instead, we looked at various approaches, and actually, the branch looked across its P&L and balance sheets and looked what its actual funding costs had been on some of those assets, bearing in mind the sort of functional currency in which it reported and the sort of mixes of loan capital that it held, and came up with a sort of a slightly better result for them in terms of level of disallowance. So I think at each of those steps, it's definitely worthwhile thinking about whether what the historic treatment has been is still relevant, or whether perhaps there's scope to try something new. So just in terms of questions, Mo, I've got a question for you on the R&D changes. So with the new AIF form coming into place from 1 August, is it still going to be necessary to prepare the detailed R&D reports?
Thanks, Ian. That's a very, very good question. So we've had this question as well before. HMRC have not been 100% clear, but what they have said is, from the information that we've got, is the AIF form is the most important aspect, because that's obviously they're keen to digitize the process as much as possible. It's got a lot more sort of granular information that would typically be included in the report. But what we've been told is actually they would like to see reports still coming through, because the AIF form, one thing that it doesn't have is a methodology section. So it doesn't actually detail how the claim was prepared from qualitative and quantitative perspective. So I think I did mention before in the presentation that we expected the AIF form to advance over time. So with that, I wouldn't be surprised if they build in like a methodology section in the future. So what we say to companies is, if you can, submit both, but the priority is the AIF form. Brilliant.
Thanks for that, Mo. I think we've got a question through for you, Martin, actually. So will the CRS new requirements consultation document be finalized so we can have a clear direction on any new requirements? So I think perhaps the question is sort of when do we expect to get some clarity around reporting requirements?
Sure. Thanks, Ian. Good question again. At this stage, I was on a panel with HMRC about a month ago, so before the OECD gave their sort of final sign-off on the changes. But at the time, HMRC were a little bit coy. They were taking lots of information from the audience, with a number of people from various banks there. So they didn't commit to when the consultation will be released. But my best guess, based on experience, is I would logically see some kind of consultation during the latter half of this year. Particularly now we have the final text from the OECD, and I think, to be fair, typically, as with when the previous CRS came in first time around, HMRC typically do take a lead compared to other tax authorities on this kind of thing, and they are very close to the OECD, it's fair to say. So I would envisage, Q3 or probably maybe start Q4, we'll see a consultation from HMRC, and following that, I would expect draft regs by early part of next year, if we're working towards this January 26th start date, which I know hasn't been finalised per se, but that would make sense to my mind. Still doesn't give a lot of time, I know, for banks and others to implement changes, but I think it's as speedy as it could be from their perspective. Yeah.
Brilliant, thanks. Another quick one for you, Mo. I think you're going to need your crystal ball for this one. Do you think the rates of relief are going to change for SMEs?
Ooh, interesting question. We hope so, because obviously SMEs are the driving force for innovation that we see. No doubt, obviously, large claimants, when you look at the spend that's been put in comparison to SMEs, large claimants typically are bigger when it comes to R&D spenders, but SMEs are sort of lifeblood of innovation, as we see, and we hope HMRC do at some point revisit the rates of relief such that they bring it in line at least with audit claimants, or perhaps have like a tiered sort of rates of relief. So, for example, they've got the high intensity R&D SME, but probably make it more accessible to a lot more companies. Yeah.
Thanks for that, Mo. I think we've probably reached the end of our time today. So I'll just say, thank you to you all for joining us today, and I do hope you found the presentation useful. Over the next few days, you'll receive a copy of the recording and slides. So please do feel free to share these with your colleagues so that they can listen into what we discussed today as well. And if you do have any questions that you didn't get a chance to ask today, or want further information or anything, then please do feel free to reach out to any of the four of us. Our details are on the slide below. And sort of finally, we've got a number of other events upcoming. I think there's going to be a slide with details on that will come out on the screen shortly. Yes, but if you've if you want to reach out or attend any of those, feel free to email fsgevents@uk.gd.com. Again, the details are on the slide. But yeah, and as I say, we'll make sure that you get included on the necessary invite list. But most of all, we do hope to see you again soon at one of our upcoming events. And thanks to everyone for joining, and have a great day. Thank you.